Welcome to Chapter 1 in Module 1, Mastering Property Analysis. In this, we're going to talk about how to see a building properly, not just as a building, but as an investment. You're going to learn about what makes a property a good investment, what is a cap rate, what is a cash-on-cash return, and what is a return on investment in the most simplified of terms. You're going to learn about condition, particularly in the US market, but these same principles apply no matter where you're listening to this at. Now, here's the truth. Most people don't know how to analyze a property. And if you don't analyze a property, then you're not an investor. You are a speculator. And speculators lose money very fast. A lot of it, in particular, people who don't run the numbers. Now, look, most people buy properties based on how they feel about them. Oh, I don't like this backyard. Oh, this kitchen isn't the right color. Oh, I hate the way that this house looks from the curb. Stop it, because that's not how money works. Investors buy cash flow, not countertops. Those can be changed. Now, let me show you how the real investors do it. First of all, let's talk about cap rates. Cap rates. First thing, what is it? Think of this like a back of the napkin test to see if this property makes money if I paid cash for it right away. It's basically, if I paid cash for this property right now, how much of a return would I get? So if the property makes $10,000 a year and it costs me $100,000 a year, that's a 10% cap rate. That's pretty decent. It might actually be garbage wrapped in tinfoil, and someone's trying to sell you on a good investment with little work, but a high cap rate. The higher the cap rate, the more money we need to make for the risk we're about to incur on buying that property. That is a cap rate. Now, cash on cash return considers how much cash I've invested and how much I will return based on that. So, if I put down $20,000 on a property that makes me $4,000 a year after all the expenses, that's a 20% cash on cash return, and that's pretty solid. So, when people ask me, Seth, is this a good deal? The first thing I say to them is, what's the cash on cash return? And then, secondly, what's the cap rate? And if it doesn't pass those two, then I realize that they're just guessing on the valuation. The 1% rule. Ask yourself, is the rent at least 1% of the purchase price? Maybe it's worth your time looking at if it meets that criteria. So, if you're buying it for $150,000, you'd better get $1,500 a month in rent. It's not a gospel truth, but it's worth you running that number to keep you from wasting your time. Location is huge. It is greater than everything because if you can fix a countertop, if you can paint a house, you can't paint a neighborhood. Look for job growth, look for population growth, look for low vacancies where people are staying and you're having a tight rental market. Look for good schools. If you see boarded up windows, if you see liquor stores on every corner, if you see the payday loans, then you might want to pass unless that's your investing strategy. Which brings us to exit strategy. When you get your money invested into a deal, how are you getting it out? You don't make your money when you sell. You make your money when you buy. So, before you buy, ask yourself a few quick questions. Can I raise the rents? Can I sell it in 3 to 5 years? Can I refinance this once it's a stabilized asset bringing in money? If the answer to all three of this is no, then don't touch it. Don't do it. There's all sorts of ways to raise the rents, raise the money, and then plan your exits appropriately so that you make the money on the front end, not on the back end. Don't let your exit strategy be a last resort. You have to think about that beforehand. So let's wrap it up. A cap rate. Is it solid and does it make me what I want? Cash on cash. Is it high enough to bring the returns based on what I'm paying for that asset? 1% rule. Does it check it off? And is it a quick yes for me to take my time to look for it? Location. Is it growing? Is it in an appreciating area? And is it worth my time? And then exit. Clearly plan out multiple exit strategies and know what you're going to do on the disposition. If you've locked in all five, that's a smart buy. If you skip them, then that's an expensive lesson. And you only make those one time. Now that you understand how to spot a winning property, here's your next move. Go to a local meetup group and partner with a team that lives and breathes with this process. You don't have to hunt down deals and do spreadsheets all day. Have to know someone who does it already. Bring them a deal, show them it, and have them run the numbers with you so you can get better and better at this every single week. Start looking at your deals without the guesswork and buy a winning investment property.